Hello there. Welcome to The Open right here on BNN Bloomberg. Let's get to those big stories we are working on in our newsroom. Prime Minister Mark Carney is set to announce new electric vehicle policies today. Bloomberg says Carney is also expected to announce a revival of those popular EV rebates, which were halted last year. The new policy will be part of a broader automotive strategy that aims to keep manufacturing jobs in this country and provide a better market access for companies that actually build vehicles in Canada. Shares in Canada Goose sliding about 20% in pre-market trading. That's after the luxury parka maker posted profit in its latest quarter that missed estimates. Margins were below expectations. The disappointing results are said to be due to heavier marketing spending and one-time charges. However, direct-to-consumer revenue rose 14%, led by strong performance in North America and Asia. U.S. companies have posted the largest number of job cuts since 2009, according to data from outplacement firm Challenger, Gray and Christmas. Companies cut more than 100,000 jobs in January, an increase of over 115% year over year. Companies also reported a decline in hiring intentions, with a drop of more than 10% from the previous year. Almost half of January's job cuts were tied to three companies, Amazon, Dow, and UPS. U.S. futures pointing to pressure on stocks this morning at the open. Let's have a look at the TSX. The TSX getting a boost yesterday from a partial recovery in gold prices. And let's check out oil this morning. The market bid oil up yesterday, and it's happening again on a report that the U.S. and Iran are squabbling over the actual format and location of talks on Friday. And let's have a look at gold. Gold, slipping again down, falling away from that 5K psychological mark. Checking in on the Canadian dollar, which has been rallying against the U.S. currency lately. It's down slightly, but still above 73 cents US. And finally, Bitcoin. It's been in something of a meltdown in recent weeks. And look at that. No joy for holders of the biggest crypto right now. Mark Burry, the hedge fund manager who was famous for betting against U.S. housing in 2007 and 2008, says on his Substack that Bitcoin is at risk of a self-reinforcing meltdown if big holders like Strategy Incorporated are forced to sell their coins. Let's get to some of the companies making news today. Barrick Mining beat fourth quarter estimates, and it's moving forward with an initial public offering, or at least preparations for that, for its big North American gold assets. Barrick, though, would maintain a large ownership share. We're joined by Garnet Anderson, Head of Wealth Management at Tacita Capital. Great to see you.
Good morning.
So they're pretty well confirming that an IPO is the plan here.
Yeah, laying down the track to go and do it, kind of create a pure play North American mines. They're a global gold mining company. So by taking the North American, putting it into one vehicle, they'll be more of a pure play. You know, there's chatter about whether does it make it an acquisition target. And because when you take a look at the mines outside of North America, there's more political instability. They've had mines that have been taken over in Valley, then taken back. That's been going on for decades for all gold companies.
Yeah.
So, but when it was announced back in December, the stock market really just shrugged. It was still too new. And I think we still say today, there's too many facts to come. How are you going to divide up the balance sheets? How it's going to roll out? So I think the market will be very much in a wait and see. They talked about over the next couple of months, they'll bring more facts to the table. And I think people can react then. So I don't see that really as a great or potential trading dynamic today that people have to really focus on, but it is coming down the pipeline in all likelihood.
Because it is complicated, isn't it? They jointly own some stuff in Nevada with Newmont, but some they don't.
Right, and then you get right of first refusal and how it all goes through. So long way of saying is, I think it's almost a little bit of a positive that stock hasn't bumped up as a result, Because if it gets delayed, which often happens, or it gets torpedoed, that might not be the thing that pulls the stock back down.
Do you think investors are going to be pressing gold companies broadly to pay decent dividends with the cash that they're piling up right now?
They're piling in. Well, I think what they're concerned is they want to make sure it's not going to silly acquisitions or vanity drilling projects. And I think Barrick's a case where that's not happening. They bought back shares with $1.5 billion, which is interesting. In the old textbooks, companies would buy back their shares when they thought it was undervalued. Maybe a little bit that, but right now more companies are like, they just have cash and they have programs and they're buying back their shares.
Buying back their shares. Sorry, even though they soared.
Well, exactly, but $1.5 billion. But when you've got that much cash, how are you getting it back to your shareholders? They have evolved their dividend. They always had since 2022, they have a base dividend and then they have like a bonus dividend, if you want. That was dependent on net cash, now become as a proportion of basically operating cash or a form of operating cash. So what they're trying to do is say, we're going to pay you back a little bit of a dividend, call that about 1.1%. And we're going to pay you back bonus dividends when the cash is rolling in. And I think that's smart. At the end of the day, though, I think if we woke up and gold prices were below the all-in sustaining cost and they need to conserve cash, they're going to cut the dividends. They are not dividend players. When you take a look at the stack of gold stocks in Canada, the yields are about 0.5%, maybe 1.25% on average. That's not why you go to gold stocks.
I wonder if they should be, because they own gold mines, for goodness sake.
They do, but it takes, the CapEx every year to step out their reserves and to build into their infrastructure. That's massive capital. And they sold 4 different mines this year, raised over $2 billion. They've got a big mine stateside that they're plowing money into, the 4 Mile project. Yeah. And so you kind of pull capital of one place, you put it where you think a better opportunity set, longer term mines with lower cost of extraction.
Would you be a buyer of Barrick now?
We hold, it's not our largest gold position. Like today, I was talking with our crack trading team this morning, where's it sitting in pre-market, just to see what the reaction was. It was off about 1.8%, but take Kinross as a kindred soul, it was off about 3%. So part of that really is just the share of gold price coming back down.
Yeah.
So we are comfortable with where it is. We tend to take and say, look, it's a high volatility stock. Give or take, it swings about 40%. Like this 1 year volatility is 40%. By comparison, what does that mean? Enbridge would be about 15%. Banks are around 16, 17%. What that means is the price is going to swing. Buyers can be patient. If you hold a position, you certainly don't have a reason to sell today. If you're thinking, I'm going to get into the gold stock trade now,
maybe
you may be a little bit late to the to the festivities sort of thing, and you may want to wait for a little bit more of a pullback, get through this. But they had good results. They impressed on the earnings per share. They met kind of metrics in terms of gold production. They've got their copper production that kind of boosted up, and you're getting that leverage that you should get in mining companies. Revenues go up 30, 40%, profits go up over 100%. Swings both ways. So yes, we are a holder. We're not actively adding to it right now, but if we did see a sell-off vis-a-vis its comparatives, we think it's a quality company. We would step in.
Bombardier's had a magnificent run since the start of 2025.
It's taken off like a plane.
But now the guy in the White House is talking about tariffs because he's not happy with the speed of Canadian approval for American jets.
Correct, exactly. And so we were watching this, we hold this in our portfolio, and we were watching this like kind of hour by hour to see what the effect was. And it did tail off, not to the point that we thought it was a great opportunity. It did not become a fire sale. It was really an excuse for people to exhale. The thing had been ripping higher. There was this news. Most people kind of went, it's going to get worked out. And so I think the views of the company, it's not Bombardier of 10 years ago. Their balance sheet's in better shape. I would say that it's better managed now. They're growing their service side, which is a little bit more dependable than plain sales. There's a dependency on plain sales. There's a backlog. But, capital intensive to retool. And then as well, as the economy goes, plain sales will go up and down. So it's nice to see them balance this out. So it's a strong stock. It too has had its volatile moments. I mean, I'm going way back. but it's now what? It's over 200, right?
Yeah. Maybe we could put up a 10-year chart, carry on.
Yeah, and let's take a look at what the price was in COVID for the brave buyers back then.
Yeah.
But having said that, it has had a series of drawdowns. I think it was down around $7 back after COVID, right? So those that had the courage to step into that particular time and ride it out, which is always hard to do. You've doubled your money, you've quadrupled your money. You know, you got your 10 bag, or do you pull out, sort of thing. But it is good fundamentals, and then the little bit of the teaser is what's going to go on with their new defense area. And they seem to be gaining some traction there. I'm not sure what the net present value of that growth will be in today's stock price dollars, but certainly it's factored into a degree. But if they can go, they've got the manufacturing capability, they've got the skill set to go there. We've talked before about what's going to go on in Canada with airplane building and what's going to be in the servicing, and now they tend to service their own planes. And then stateside, you know, they've got servicing centers down there. They sell a lot of their planes into the States. They've got some business going down there with the military. So can that grow? They're obviously optimistic. So I think that's the teaser on the outside.
Garnet, always great hearing from you.
Pleasure to be here. Thank you.
Garnet Anderson of Tacita Capital. Up next, we're going to hear why the CEO of the oil and chemical firm Phillips 66 is optimistic after a tough cycle for the chemicals business, and how the company says that its oil business is well positioned to process an increase in Venezuelan crude. The CEO of Phillips 66 says the chemicals business is at the bottom of a tough cycle. We got perspective in a Bloomberg interview, and they began by asking him when this tough downturn will finally start to recover.
When you look at the strong results we had in the fourth quarter, it really stacked on top of the good results we had second and third quarter last year. And the precursors for that outstanding performance really were set in play over 4 years ago when we started down this path. We committed to pushing our refining assets into world-class status. We committed to building out a great midstream position, wellhead to market with our NGL system. And we committed to reducing costs. We streamlined our business. We've sold over $5 billion worth of assets. And it is all starting to come together in our results. And you saw it in our fourth quarter performance.
Absolutely. Well, if you were looking for something to quibble with, I mean, we had a few analysts take a look at what's going on in chemicals. There was some weakness there. Chemicals overall, they've been in a bit of a drawn-out down cycle, if you want to call it that. So what's your outlook when it comes to chemicals? Could we be nearing an inflection point?
Well, chemicals is at the bottom, I think, of what's been a very tough cycle. Fortunately, CPChem, our joint venture with Chevron, has performed well at the bottom of the cycle. When others are losing money, shutting down assets, they've been able to run their assets at high rates and have positive earnings. So our share of their earnings in 2025 was over $800 million of EBITDA. So they're doing what they're designed to do, and that's compete in any environment. We are bullish long-term on the fundamentals of that business, and it will eventually turn. We're seeing rationalization today across the globe. The U.S. capacity is running at about 90%, but if you look at Europe and Southeast Asia, they're running at about 65% because the assets aren't competitive, and many of those assets are being rationalized as we speak.
Mark, I am curious, though, too, on the midstream business here. I mean, what is kind of your general expectation with regards to growth rates in that business? And I'm primarily talking like organic growth rates rather than through acquisition.
Sure, Romaine. We've got a plan to continue to grow the earnings in that business mid-single-digit percentage-wise. We've got great opportunities organically to grow, add gathering and processing assets. We've got a pipeline, our Coastal Bend pipeline that we recently expanded. There's another 125,000 barrels a day of capacity that we can expand into as well. And so we've just got a good pace of growth over the next several years. And we see us by the end of 2027 hitting $4.5 billion of EBITDA in that segment.
Mark, I do have to ask you about the situation in Venezuela and the potential impact of more oil coming onto the market. I know that's still a long ways away, a lot of political issues that have to be sorted out. But how is that now factored into both the outlook that you're giving, but more importantly, into your own internal planning for your business?
Sure, Romaine. As a North American refiner that has assets that were designed to run Venezuelan crude, we're optimistic that that will all come together. We're optimistic for the people of Venezuela that it will generate good economics for them. There is crude flowing out of Venezuela now to U.S. refiners. We've got the ability to process about 250,000 barrels a day. We were consuming Venezuelan crude before President Maduro was taken away, and we continue to process Venezuelan crude today.
So I want to talk about that figure, 250,000 barrels a day. That's something you reiterated on your earnings call this morning as well. Are you actually running that level, or are you just saying that you have the ability to? And if it's the latter, how do you see getting up to maybe that figure?
We have the ability to do that. That would be a significant portion, a significant percentage of the crude coming out of Venezuela today. But we have the ability to ramp up as the crude is available and as the economics dictate. We'll only run Venezuelan crude if the economics indicate that that's what we should run. But we do have that capability. And when you look at our total crude capacity, I believe we have the highest percentage capacity that can run Venezuelan crude out of our whole portfolio.
CEO of Phillips 66 talking to our Bloomberg partners. Coming up, we'll do a more in-depth check on the markets. We'll have a look at some stocks you might want to watch at the open. Oh, thank you very much indeed for tuning into The Open. The former Prime Minister, Stephen Harper, has called for the Liberals and Conservatives to come together for the benefit of Canada. The current Prime Minister, Mr. Carney, met with the Conservative leader, Pierre Poilievre. CTV's senior political correspondent, Mike Le Couture, has more in this report.
Good to see you. This is not hope. This is not hope over here. Oh, look at this.
The Conservative leader with a dig at his Liberal colleagues ahead of a meeting with the Prime Minister.
We have been working to fast track anything that we believe, however modest, might make life a little more affordable, a little safer, and our economy a little stronger. So it's he that is holding up the show.
According to readouts from both leaders' offices, Carney and Poilievre agreed they need to work quickly to pass policies that will make life more affordable for Canadians. The Conservative leader also offered his help in Canada-U.S. negotiations.
In fact, we need to work together.
Conservative MP Jamil Javani, meanwhile, is heading to Washington this week on a solo mission to improve trade relations between Canada and the U.S. He's a longtime friend of U.S. Vice President J.D. Vance.
I haven't talked to him in about a year about those issues. I would like to use that relationship for the good of the country, but I also don't want to interfere in what the Prime Minister's doing.
Giovanni was pushing for a meeting with the Prime Minister, but he did get one with the minister in charge of Canada-U.S. trade.
Minister LeBlanc gave a briefing to Mr. Giovanni, who I don't believe is the trade critic for the opposition, certainly not the Minister of International Trade, nor the Prime Minister.
But some members of cabinet are casting doubt on whether Giovanni can or will help.
I really hope that he spoke about the closure of GM in his writing, because Ingersoll has been closed for now 4 months, and I haven't heard him once.
While a number of Conservative MPs are confident Giovanni can use his contacts to make a difference, Poilievre says he told his MP the most important thing is to fight for the jobs in his community. Mike Le Couture, CTV News, Ottawa.
Let's check out market call yesterday. We were joined by Cole Catcher, Senior Investment Advisor and Portfolio Manager at Wellington Altus Private Wealth. His topic, North American stocks and ETFs, and his top ideas, Amazon.com, Chipotle, and the Evolve FANGMA Index ETF, hedged to Canadian dollar. That's a tech play. Today on the show, speaking of tech, it's Kim Bolton of Black Swan Dexteritas. And yep, he is taking your questions on the tech stocks I'm sure a lot of people want to hear, what does he think? Will AI hollow out the software as a service business? And let's see how the markets are looking south of the border. Looks like we are going to get a weaker open amid concerns over these software stocks. And we also got U.S. jobless claims topping estimates. However, it was a week that was hit by extreme cold. And so you can see the NASDAQ set to open down around 1%. And let's see how the major Asian markets have traded today. They too down, of course, Asia with major tech exposure. The NVIDIA, according to the Wall Street Journal, is warning the White House that rules governing chip exports to China are too strict and would eat into demand. It says the restrictions on sales of its H200 chips, very advanced AI devices, are too onerous, and it could destroy plans to actually profit from those exports. Let's have a look at Europe. You see those stocks are down as well. There's a report, it was either in the Journal or the Wall Street Journal, about an unofficial war game study carried out by a bunch of defense experts in Europe. And they concluded that Russia, under guise of a humanitarian mission to their Kaliningrad enclave, former Königsberg, could put, with as few as 15,000 troops, establish a big foothold in the Baltics. So lots of tension there. Let's see where the TSX finished the day yesterday. And you can see it was up slightly, boosted, of course, by a partial recovery in gold stocks. Still down, though, from that record of 33,176 on Wednesday of last week. And let's check out some of the big winners and losers yesterday. Constellation Software rallying. And now, of course, of late, that's been hitting multi-year lows on fears for the software, the conventional software business. West Fraser Timber higher. We saw a rally, actually, on brighter expectations of the lumber stocks. Bitfarms down, always volatile, those crypto-related stocks. And Energy Fuels. Now, I don't think I saw any news about the company or nuclear. And we have, of course, uranium prices lately have hit the highest since 2024. Okay, I think BC, it's a stock to watch today. The parent of this network, Desjardins, says that the results were in line amid what it calls heated rivalry in the wireless business. However, the guidance was a bit soft. We're going to be back with those opening bells. There you have it, the opening bells at the NASDAQ. It's Icon Therapeutics doing the honors. At the NYSE, it's Bob's Discount Furniture celebrating its initial public offering. I wonder what that company does. Okay, it's time for the first 15. Trading just getting underway, and let's check in on the equity markets. We did see weakness in the pre-market for U.S. stocks, and you can see they are down again with the NASDAQ, always volatile, down about 1.5%. Job cuts high in January, and that may be casting a shadow over investors' view of the economy. People are, according to Bloomberg, have been retreating into U.S. bonds amid what Bloomberg calls angst in the job markets and the job market. And of course, that is increasing the case, some think, for the Fed to start cutting interest rates again. And there's our beloved TSX. It is down around 1.2%. We saw weakness in gold stocks this morning, with gold slipping away from that $5,000 US level. And that, of course, has been a major driver for the TSX over the past while. A couple of individual stocks here. BCE, the parent of this network, down a little bit in early trading. As I mentioned, Desjardins says, sure, the numbers were in line, but the guidance looks slightly softer than expected. And punning on that show about the gay hockey players, Desjardins says this is in the context of heated rivalry in wireless. And of course, that's been a major global hit for BCE's Crave. People all over the world loving that show. Let's have a look at Canada Goose. Investors not thrilled by the latest numbers from that company, or certainly they weren't in the pre-market. Oh, the stock down about 15%, giving up practically all of its gains over the past year. Pressure on margins apparently worrying investors. Direct-to-consumer revenue, though, not far short of 600 million Canadian. So direct-to-consumer, of course, that's pure profit. Revenue was actually up 14% year over year in the latest quarter. That's interesting. Wow, direct-to-consumer revenue almost 600 million, and wholesale revenue not quite 90 million. So it sounds like their model is overwhelmingly direct-to-consumer. Thomson Reuters reporting an earnings beat, slight earnings beat, and that stock rallying. But of course, it's been an ugly story for Thomson Reuters, along with other data and software stocks over the past year and more. We were calculating yesterday that decline in the stock from its record high of July looks on paper to have cost the Thomson family, who owned about 2/3 of the company, more than $50 billion Canadian in paper wealth. And let's have a quick look at Alphabet. They are pressing ahead. Damn the torpedoes, with spending on record spending to win AI customers, building out data centers and infrastructure. It looks as though, even though the company saw momentum in cloud and search advertising, the backlog in cloud doubled, people are a little wary of the massive capital spending involved in this AI battle. And Qualcomm shares, they took something of a hit in the pre-market, and they're down in early trading. Revenue forecast weaker than expected. And let's have a look at Estee Lauder. That stock has been hot, but hitting the wall right now. Underwhelming guidance, worrying investors after the big rally in the shares. Up next, we will get more insight into what's moving in early trading. Welcome back. Of course, the big theme over the past week and more has been weakness in software companies. That has contributed to market volatility. Our guest has some ideas for your portfolio that he thinks will cut through the noise. We are joined by Sherez Ahmed, CEO of Sartorial Wealth. Great to see you.
Thank you. Great to be back.
And of course, you're a quant, mathematically focused player in the market.
Absolutely. As a portfolio manager, we tend to focus more on momentum as our primary factor that we follow, but also risk-adjusted return and a few other variables as well.
Could you give me your broad thoughts on this pessimism in the software stocks? Maybe if we put up a 5-year chart for Adobe, just as an example. I mean, that seems to have a lot of downward momentum right now.
So it does right now. And again, I think some of it may end up being overblown as time progresses, because I think right now we're seeing that the application of AI is really now being called in. And so before it used to be just a lot of question and answers, things of that nature, fairly simple use cases. But now that we're seeing that it has some ability to do more complex needs, there's always the risk and concern that perhaps SaaS or software in general may be at risk. So I think right now we're not sure which the obvious winners and losers will be over time, but I think it's something that everybody needs to be watching. I think right now there's a little bit of I guess, overblown market sentiment.
One term we're hearing more of is vibe coding, and apparently that's where you use AI to build software, but you just use natural language.
Yes, it's actually remarkable on what it can do. You don't need to know anything about coding. So even if you think back just a few years ago, a lot of the rhetoric was to especially younger folks learn coding. Well, now all of a sudden everybody's vibe coding. So it is definitely disruptive. I don't think there's a question about that, but I don't see there, at least in the short term, that these software companies are completely going to vanish.
Yeah, the Wall Street Journal in the Herd on the Street column says the belief that major corporations will replace highly complex software platforms with vibe-coded apps is a stretch. Because this is stuff like payroll, and I mean, it's mission critical.
It's extremely complex. So I don't think that this is going to be an easy replacement. Now, perhaps over time, there may be some risk, but in the short term, I don't think that there is. So right now, this is just a most recent excuse for people to look at the stretch valuations in AI and perhaps take a bit of profit taking, frankly, happening overall.
You have some ideas for us. Let's get to your first one, Next Era Energy. Tell us what attracts you to this stock. NEE is the symbol.
So if we're still on the theme that AI is going to be a big play going forward, well, this is again back to something we talked about earlier in my last visit, the picks and shovels on AI. So Next Era being a very, very large, arguably one of the largest electrical utilities in the world by market cap. So we're playing the fact that they have the power generation, the data centers need power. They've signed multi-deals with all sorts of hyperscalers. So I think this is something that we like overall as a way to play AI without necessarily being in the hyperscalers themselves.
What about Quantus Services, PWR? Remind us what they do.
So Quantus is, again, an infrastructure play, again, on the energy side. So another picks and shovels opportunity for folks to participate in. They're one of the ones, if you are still thinking that the AI theme still has legs in it, well, then this is a way where there needs to be electrification of the United States. There has to be continued updating and modernization of the grid as well, and they're one of the best ways to do that.
And that stock, wow, look at that, up more than 50% in the past year. Like so many stocks, it bottomed in April. Maybe we could put up a 5-year chart. I'm not sure if your analysis really gets into this, but do you track the risk of euphoria in some sectors?
So generally, yes, we're always aware of it. But again, momentum is all about the trend is your friend. So at the moment, the trend is still our friend. And we're in there. What we'll often do is miss the first beginning part of a rally, and then we might miss the last little bit, but we'll get the meat in the middle. And that's always the goal behind it.
The meat in the middle. Okay. PWR. Okay, we've dealt with that one. Morgan Stanley is your next idea.
Yeah, so this is, again, a much more stable name relative to the other two. Morgan Stanley being, again, a diversified financial services company. They have done a phenomenal job with a lot of their M&A activity and investment banking over the last year. Asset management services and wealth management, again, have been also big revenue drivers. You know, this is over a $9 trillion asset manager, and they're phenomenal. And again, it's been a very stable company for quite some time, so it's one that we like.
I wonder, will we see private, the Wall Street Journal suggests that we might see private equity swooping in on some of these software companies. It says the valuation has gone down from about 39 times forward earnings to about 21 times now.
So there may be the opportunity for some of these PE activity to actually start stepping in. I think that is where some of the risk is coming in, why some folks are getting onto the sidelines, just a bit of a wait and see pattern. I do think that there will be likely some opportunities in software.
And what about at your own shop, your mathematicians? Are you using AI to code?
Absolutely. So we're using AI as part of the background of what we do, including the help deployed of AI agents across the world to be able to help us filter down the investable universe that exists out there. So absolutely, we are using it. Yeah,
I find AI can be very useful for finding information. You don't want to trust it. In fact, you'd be reckless to trust it implicitly, but it directs you to reliable sources, I find.
It does a phenomenal job doing some of those repeatable tasks and be able to filtering down the universe for us, for example. But again, you can't blindly just look at the data that's coming out there. A lot of it sometimes can be factually inaccurate.
Yes.
So it does need human eyes and trained human eyes. So you can't just use it on its own.
Thanks very much indeed.
My pleasure.
Okay, that was Shiraz Ahmed, CEO of Sartorial Wealth. Coming up, speaking of software, we are watching shares in Lightspeed, a company in retail sales management or cash payment systems. It just reported results this morning, and we hear from the CEO, Dax De Silva, after the break. Let's check out shares in Lightspeed this morning. The Canadian tech player, a specialist in retail payment systems, processing payments for stores and restaurants. Stock slightly down, and it is off more than 30% in the past year. The headline I'm seeing is that the adjusted EBITDA forecast missed estimates very slightly. Let's get more from Dax De Silva, CEO and founder of the company. Dax, thanks very much indeed.
Thanks for having me.
And just update us. I know I ask you this all the time, but you're a specialist in brick and mortar payments for restaurants and retailers.
Yeah, we build the whole system for running those businesses. So complex retail and hospitality businesses. The retail businesses are primarily in North America, and the hospitality businesses were the #1 system in Europe. So we do the end-to-end operations as well as the payment processing.
Right. Do you provide value-added services to companies? I mean, do you provide loans or lines of credit and stuff?
So as an extension of our payments platform, our financial services platform offers merchant cash advances. So yes, we have a capital business that's vibrant and growing as well.
So tell us what your stock is down in the past year. Just remind us why that is.
So we're doing a very disciplined transformation, which is prioritizing our 2 growth engines. That's 2/3 of our business, our North American retail business and our European hospitality business. And we showed, fantastic results, for Q3, but for those growth engines in particular, really top tier 21% growth in those growth engines and 2,600 net new locations. So adding a lot of locations on those growth engines, and in addition, 13% software growth. So the strategy is really paying off. We set a 3-year CAGR for getting to 10 to 15% location growth, and we're at 9% right now. So we're very much on track. And we're also on track for our 3-year EBITDA target and our gross profit target. So, it's a quarter by quarter story of execution, but very, very pleased with how we're delivering.
So you raised your revenue guidance for fiscal 2026. I mean, you're a huge company to north of $1.2 billion. And it's up slightly, but it looks as though your EBITDA, interesting, below the street, $72 million approximately, and the street was closer to $73 million. So really not a huge difference, I know. But why is that profit forecast slightly lower than the street, do you think?
Right. So, we've accelerated on our locations from 5% in Q1 to 7% to 9%. And that's really because we've been investing in outbound salespeople in North America retail and European hospitality. In European hospitality, it's more field reps going restaurant to restaurant in major European centers. And in North America retail, it's outbound remote reps calling into key verticals like apparel and footwear and sport and outdoor businesses, leading with our wholesale platform that's called New Order. So those reps are a big investment. We've hired all 150 reps, and we're ramping them to full productivity. But we've had so much success that we're bringing forward some of that hiring into Q4 so that we can start fiscal 27, with fully ramped reps, tackling, in particular in this case, tackling that retail business, which has got a massive TAM.
So I'm not a big foodie, but my rule for eating in Europe is if the menu's in English, don't go there. So say if I'm at some place in the back streets of Siena and I'm running a small restaurant, why would I go with your payment system? I'm sure my local bank could offer me something equivalent.
Yeah. So when you go to Michelin star restaurants or you go to resorts, and actually if you go into almost any cafe or restaurant in Europe that's got table service or a bit more complexity, you'll see Lightspeed. And I think all the businesses recommend Lightspeed to one another. It's a little bit of a support network within their own within their neighborhood. It is the system, especially when you're doing multi-course meals. Of course, Michelin star restaurants, but then even casual dining, anywhere that there's table service, or you have a multi-location chain, or you have a restaurant as a part of a hotel or a resort. We are an excellent fit.
But you haven't got the same traction in restaurants in North America?
Yeah, I think what we did when we unveiled our strategy at Capital Markets Day last March, we looked at where our two products, our key flagship products, which are the retail product and the hospitality product. The hospitality product has DNA that comes from European acquisitions. So it's really, tailored and fiscalized for all of those different countries. There are particular workflows and different partners in the ecosystem in Europe. And so, previous to the new strategy, we were trying to sell that software all over the world, and there was low ROI in other areas outside of where that software actually comes from, which is Europe, and in North America. And so we've been building out that software for about 10 years. And on the retail side, we've been building out that software in North America in key verticals for 20 years, starting with the very first software that I built back in 2005. And they don't let me program anymore, but but we've built out, a really incredible and deep retail expertise in high complexity, inventory centric retail verticals in North America. And so that's where we have the best close rates, the highest rate to win, the biggest competitive moat and differentiation now with our wholesale platform built right into the retail POS. And then, of course, in Europe, we are the number one, full service restaurant system in Europe. So, and that's how our numbers have just really benefited quarter after quarter since we began the transformation of focusing on where we have a right to win and where we have virality and fantastic close rates.
One story that caught our eye this week, a BBC story, we hope to get to it later, is that when people order on these screens that you'll see at fast food restaurants or in IKEA at the food their restaurants, people tend to order more. Now, I don't know if those screens or automated food ordering things are a big part of your business, but have you heard, does that tend to boost revenue for the restaurant?
Yes, we do partner with companies that add kiosk capability to our platform. We do see that. Whenever you're not in front of someone and you're ordering, your food, and you've got a little bit of privacy, you're ordering more delivery, you're ordering more at a kiosk. But for the most part, we're serving those restaurants where people are going out as entertainment to dine and also on the retail side to shop, right? So there is a brick and mortar, a physical, social entertainment element to it. But yes, we also serve those scenarios where people are sneakily increasing their order because nobody's watching.
Just finally, we're tight for time, but your operations are so interesting. People are drinking less, certainly in North America. I don't know if that's a trend in Europe, but that must be tough on restaurants because that's typically a high margin item, booze.
So we often do trend pieces, and we did a big trend piece on some of the things that are popular in restaurants, and mocktails have become extremely popular. Right. As you said, there's the younger generations are not drinking at the same level that other generations did, but mocktails are certainly popular, and there's a lot of different food items. There's different times of day that people are starting to go out earlier, and that's why we have a tool called Benchmark and Trends for restaurants in Europe, where it can do some spying for you. It can tell you what other restaurants in your area that are in our network, anonymized, of course, what they're charging, for drinks, what they have on their menu that maybe you don't in terms of a mocktail or an idea, and what time are they doing their happy hour, what time are our customers coming in, because those shifts are happening generation to generation, and as a restaurant owner, you want to be on top of that, or you might be missing out on an opportunity.
Dax, could talk to you all day. Thank you very much indeed. Really appreciate it. Dax da Silva, CEO and founder of Lightspeed Commerce. Coming up, this will be, or could be, one of the most closely watched IPOs in years. Investor excitement is building, and there are lots of questions over SpaceX going public with what could be a $1 trillion valuation. New reports suggest SpaceX is talking to bankers about its hotly anticipated IPO, with the company's valuation reportedly running well above $1 trillion US. What exactly will people be buying into? We are joined by BNN Bloomberg contributor John Ehrlichman. John, you've done a deep dive on SpaceX for your Ticker Take YouTube channel. Tell us what you found out.
Yeah, and we're going to put up a story on the BNN website as well, Andy. You know, it's interesting. All the incremental reporting right now, to your point, is about which bankers SpaceX might work with, when the IPO might take place. It's like we've fast forwarded beyond what the actual business is. And I know everybody talks about the rockets, but there is a bigger driving force behind SpaceX, and that is their satellite business. Now, over the last decade, they've been able to prove that they had reusable rockets. That was the scientific breakthrough that allowed them to really allow the business to overall mushroom. And what I mean by that is initially, great, you're lugging cargo on behalf of the government into orbit. But the bigger part of the business has them been lugging their own supply, their own satellites to build Starlink in space, so much so that that is the lion's share of the revenue right now and the fastest growing piece. Now, there's another component here, which is that Elon Musk wants to take even more stuff into space. That's why he's been building Starship, which you hear a lot about, and they'll take bigger satellites into space. Their plan is to take on the telecom industry with direct cell service and eventually to build all sorts of monstrosities. You've heard him talking about building these data centers to fuel the AI boom.
That's interesting. Yeah, I mean, he's already offering internet services via SpaceX. That's interesting. Cell service, that'll raise regulatory questions. So, of course, we know that Musk has big visions, sometimes big promises that don't transpire within the time frame people expect. So it seems like this IPO is a mix of actual business with big promises for the future.
I think that's right. And I think it actually speaks to the time we're living in, Andy. Like you and I have been covering the markets for a long time. I can't remember a moment where investors were more willing to invest in a decade-plus long trend. You've seen it with some of the AI stories. You hear about it with some of this sort of geopolitical reshaping of the world and nation building and big infrastructure projects. With the performance in the markets, it does feel like there is a willingness to accept that there might be something coming in the future with no defined terms around it. And I think the other thing is that investors have had a little bit of an experience at this point with some of the small space companies that are public. And maybe they just believe in the SpaceX story more because they are so dominant after these other companies had a run up. But you're absolutely right. Once we've got a prospectus, that will be very helpful. It'll tell people what is fueling the business today and how much you can bank on as an investor tied to the future today, which is a little bit less tangible.
John, thank you very much indeed. John Ehrlichman, BNN Bloomberg contributor and host of the Ticker Take YouTube channel. Just ahead, we are going to get perspective on this sell-off in the software sector. Are investors overreacting? Welcome to the second hour of The Open. We are expecting to hear from the Prime Minister on Canada's new auto strategy. We'll bring you that live when we can. But first, let's check out the big stories we're bringing you from the BNN Bloomberg newsroom. Shares in BCE under a little pressure in morning trading. The telecom giant posted profit in its latest quarter that beat estimates, but it did see operating revenue fall below expectations. BCE says it does expect higher revenue and profit driven by improvement in wireless pricing, a boost in product sales, and growth in its AI-powered segment. Reminder that BCE is the parent company of BNN Bloomberg through its Bell Media division, and we are planning to talk to BCE's CFO at 1 p.m. Eastern today. Shares in Canada Goose sliding 16% after the luxury parka maker posted profit in its latest quarter that missed estimates and margins were below expectations. The company said it had heavier marketing spending and one-time charges. However, on the upside, direct-to-consumer revenue jumped 14%, led by strong performance in North America and Asia. Shares in Barrick Mining down a bit, well, actually almost 6%. The company posted profit and revenue in its latest quarter that topped estimates. However, investors are pointing to a weak outlook for 2026 production, as well as free cash flow that missed expectations. Barrick says it will spin off its North American gold assets in an IPO, which will include interest in operations in Nevada and the Dominican Republic. Barrick will retain, however, significant control. And the TSX down a little in early trading, just looking at who is posting big trading volume right now. Enbridge is ahead, Bank of Montreal slipping about $1, and Celestica higher by about 7%. But as we just saw, Barrick is down almost 6%. I'm just seeing if I can compare that. Yeah, Kinross Gold is down almost 4%. Okay, and let's have a look at the US markets and see what's trading heavily there. Amid misgivings over the software industry, Berkshire Hathaway slipping a little bit. Alphabet down, and we're going to have lots more. We'll speak to Dan Ives of Wedbush shortly on Alphabet. Alphabet down around 3%, Nvidia 1% higher, and Tesla down about 2%. And I'm just looking, Palantir actually losing a little bit as well, down 3%. Oh, Lilly giving up some of yesterday's gains. It is down around 7%. That company, His and Hers, which is an aggressive marketer of weight loss drugs, has announced apparently a $49 US copy of the Wegovy pill. Well, let's head now to Woodbridge, Ontario, where the Prime Minister, Mr. Carney, is set to outline Canada's new automotive strategy. And here, first off, is the Industry Minister.
The question before us is clear. How do we protect what we've built while positioning ourselves to lead what comes next? And our answer is simple. We are an auto nation. We have the best auto workers in the world. And we will build the best cars in the world for the world. And we will invest in those who invest in us. So, without further ado, ça me fait plaisir de vous présenter l'homme de la situation, la personne qui va nous présenter la stratégie automobile,
the person who will present the auto strategy.
Right Honorable Prime Minister Mark Carney.
Merci beaucoup. Thank you.
Thank you.
Thank you very much, Minister Joly, Minister de Bruzen, caucus colleagues. Let me just start. This is a great day. It is a great day. It's always a good day to be back at Martinrea. I want to just thank the team here, Rob, Fred, Venkata, all the team here. This is an extraordinary Canadian success story. This is a great day because we're celebrating a couple of births. We are celebrating the birthday of Rob Wildeboer. Because of Flavio Volpe's many contributions, we are celebrating the birthday or the unveiling of the Aero 2.0, which shows what the future of automotive in Canada is. And we're celebrating the future of the world's greatest auto industry. We are here where Canada Strong is forged every day. This company, nearly 20,000 skilled workers come together to build the engine blocks, the transmission housings, the control arms, the future that helps drive our auto industry and our economy. And as you just heard, but you know this, you just heard from the minister, this is a pivotal moment both for the industry and our economy. We know that U.S. tariffs have upended the bargain that's existed for as long as I've lived. It's put our workers, our businesses, our country under a cloud of uncertainty. We also know, you see some of the innovation here, we know that the global auto sector is being radically transformed. Rapid shifts towards lower emissions, towards greater connectivity, towards even more advanced manufacturing. So the decisions that Canada makes now will shape careers, communities, and our economies for decades to come. And we will not miss this opportunity. A confident Canada, like a confident Martin Rea, confident Canada is making the strategic decisions and the generational investments today to build the affordable, enjoyable, and low emissions automobiles of the future. As Minister Joly just said, Canada is an auto nation. The auto industry is central to our story. In fact, the first automobile manufactured here was in the year of Confederation, 1867, in Stansted, Quebec. Henry Seth Taylor built the first Canadian-made automobile. The Taylor steam buggy was powered by a simple coal boiler and mounted on a wagon wheel carriage. It was a one-off, hand-built machine, never intended for mass production, but it proved Canadian-made automobiles are possible. 158 years on, the auto industry is the core pillar of the Canadian economy. More than 500,000 Canadians wake up every morning, go to work, and bring home a paycheck because we make cars in this country. Entire communities have been built around car plants. Cities, towns, Windsor, Alston, two examples, the auto sector remains the largest employer. Aujourd'hui, l'industrie automobile canadienne
the Canadian auto industry is one of the largest in the world. A big part of that success stems from our trade relationship, our close trade relationship with the United States that has been built over decades of cooperation between the two auto cities on both sides of the border.
There's no greater symbol of how closely the Canadian and American economies have been intertwined than automobiles. The average car is built from parts that travel across our border up to 8 times before landing on the showroom floor. 90% of Canada's finished vehicles, 60% of our auto parts are exported to the United States. But that trade relationship that once was a great strength has now become a serious vulnerability. Now, I want to be clear. Canada still has the best deal of any U.S. trading partner, with 85% of our trade with the United States remaining tariff-free and the lowest average tariff rate in the world. And as we prepare for the joint review of CUSMA that will begin later this year, Canada's new government remains focused on protecting this unique Canadian advantage. Our objective is to remove all tariffs in the auto sector to build the strongest North American auto sector. That's what we will build together. But we recognize that that is not the current objective of the U.S. administration. Their approach has changed. It's their right. So we have to prepare for all possibilities. We must take care of ourselves. We
cannot control what others do. We can only control what we do and what we build. And we are building a stronger, more resilient Canadian economy that is more independent. We've put in place new strategic measures for workers and businesses in the sectors that have been most affected by U.S. tariffs. These initiatives and workers in the steel, auto sector, the forestry sector, and other strategic sectors in Canada have all acquired new skills. These initiatives will also help companies to adapt and diversify their products.
Our government has already implemented the most comprehensive set of trade resilience measures in Canada's history. We've moved fast, and we're already seeing results. Our measures have created and protected 18,000 jobs across steel, aluminum, lumber, and the auto sector. They've prevented more than 20,000 layoffs. We've unlocked almost $1 billion in private investment by small and medium-sized businesses. We provided income supports for more than 6,000 workers, with a total of 190,000 more expected to benefit, including in the auto sector. Nos travailleurs sont le moteur de notre économie.
Our workers are the driver of our economy. So as we transform our industries faced by the trade measures taken by the U.S., we will ensure that Canadian workers can equip themselves with the tools they need, what they need in order to accomplish this transformation.
Of the auto industry is increasingly electric and connected. And so to remain competitive and to realize our potential, we must develop the entire value chain for next generation vehicles, harnessing Canada's exceptional capabilities in auto production, including the world's greatest workforce, including globally recognized parts suppliers and leading-edge research and development. We'll combine these strengths with new battery supply chains that will power the future of mobility, reinforced by Canada's IT expertise, world-leading AI and robotics technologies, to position Canada as a global leader in vehicle electrification and autonomous technologies. In the coming weeks, our government will unveil a new electricity strategy to double, I'll repeat, to double our grid capacity, to modernize our infrastructure and to deliver electricity that's more reliable, more efficient, crucially more affordable for Canadians. This will enable Canadians to adopt low-carbon technologies such as electric vehicles while supporting the electrification and growth of our industries. With our deep talent, thank you. With our deep talent, our research strengths, our innovation ecosystem, we can lead the development of the connected and autonomous technologies that will shape the future of transportation. We will prioritize diversification, including new opportunities that will be created by Canada's defense industrial strategy to strengthen the industry and its supply chains while leveraging our existing trade agreements around the world. Les travailleurs et les industries du Canada sont
Canada's workers and industries are well positioned to take advantage of this opportunity. We are making generational investments in competitiveness and critical minerals, including those that are needed to build electric vehicles. And this is to build our strength in the supply chain. Canada will be one of the only countries in the world to have whatever is needed in the to have a full supply chain for EV batteries. We have an 80% clean energy network and some of the lowest cost of electricity and industrial electricity in the G7.
So we have everything we need to take the lead in the vehicles of tomorrow. And we're positioning Canadian workers and businesses to seize that opportunity. That's why today we're announcing a series of strategic investments that will shape the future of mobility and advance manufacturing in Canada as part of a coordinated plan to build a stronger, more competitive, more independent country. Our strategy rests on 5 pillars. First, accelerating investment in Canadian auto manufacturing. Second, rationalizing emission reduction policies to focus on the outcomes that matter to Canadians. Third, strengthening domestic demand by making electric vehicles more affordable and reliable for Canadians. Fourth, establishing a comprehensive trade regime that strengthens the competitiveness of our auto sector. And fifth, protecting Canadian auto workers from the immediate pressures while helping them bridge to the future. So let me get into a few of those details, and I'll take questions. First, we're accelerating investment across the auto value chain. To support strategic investments by our companies, we're dedicating $3 billion from the Strategic Response Fund and $100 million from the Regional Tariff Response Initiative. This is capital that will help our businesses respond to those trade disruptions, help them pivot their operations, retool plants to increase productivity, invest in advanced manufacturing, and expand into new markets. In line with our Buy Canadian policy, the government will leverage these investments to maximize opportunities for Canadian suppliers, Canadian-made goods and services, including in steel and aluminum. We're also implementing the most comprehensive investment incentives for the auto value chain anywhere in the world. The new productivity superdeduction will reduce Canada's marginal effective tax rate on investment to 13%. That's more than 4 percentage points lower than in the United States. That means and let me be clear, this is very broad. It means businesses can immediately expense 100% of their investments in manufacturing machinery, in equipment, in buildings, in zero-emission vehicles, in clean energy equipment, in scientific research and development, in productivity-enhancing assets, including patents, data network infrastructure, computers, and beyond. Further, in addition, because this is in addition, to accelerate investment across the low-carbon mobility value chain, we're implementing the Clean Electricity Investment Tax Credit, we're expanding the Clean Technology Manufacturing Investment Tax Credit, and we're including a wide range of critical minerals. And we are reducing the tax rate for zero-emission technology manufacturers so they benefit from 1/2 of the normal corporate tax rate, and that is before these deductions. Put simply, we're making Canada the best place to invest, the best place to build, the best place to build clean. Our second pillar is to adapt our emission reduction policies to focus on outcomes. Canada will set a new, more ambitious, sovereign path to reduce automobile emissions. We'll drive down emissions by more than doubling the stringency of Canada's vehicle GHG standards by 2035, achieving the equivalent emissions reductions of a 75% EV adoption rate. We won't stop there. By leveraging new investments in EV production, consumer incentives, and charging infrastructure, we'll work towards achieving the equivalent of a 90% EV adoption rate by 2040. The more stringent emission standards will enable the Government of Canada to repeal the Electric Vehicle Accessibility Standard, so-called EVAS. Replacing EVAS with those stronger vehicle emission standards focuses on the results that matter to Canadians, while avoiding placing undue burdens on the Canadian auto industry. This approach allows manufacturers to use a wide range of technologies to meet the standards and to respond to consumer preferences in the near term, all while driving EV adoption over time. The third way we will transform our auto sector is by becoming our own best customer. Au cours des 5 prochaines années,
over the next 5 years, the sale of electric vehicles should account for more than 40% of all auto sales. Today, nearly 80% of the EV vehicles produced in the world come from China and the US. Canada cannot let itself stay behind. Electric vehicles are the future, and our government is determined to ensure that this future is built by Canadian workers, manufactured in Canadian factories, and driven by Canadian cars.
And we have a strong domestic market. We can buy what we build. And so the government that's why our government is launching a new $2.3 billion electric vehicle affordability program. Canadians who purchase or lease a battery electric or fuel cell electric vehicle will receive up to $5,000 and up to $2,500 for plug-in hybrids priced up to $50,000. To support the Canadian auto industry, this $50,000 cap will not apply to Canadian-made EVs or Canadian-made plug-in hybrids. And those incentives will only apply to vehicles produced in countries with whom Canada has a free trade agreement. We're also going to make it easier and more convenient for Canadians to charge their EVs, because too many Canadians worry about being able to reliably get charging on journeys, especially in rural and northern communities. To help fix that, we're developing a new national charging infrastructure, a new strategy, $1.5 billion of investment through the Canadian Infrastructure Bank. So wherever you live in Canada, charging your vehicle should become as simple as filling your gas tank. The fourth pillar of our strategy is to establish a comprehensive trade regime that strengthens the global competitiveness of our auto sector. Again, to be clear, Canada continues to favor a zero-tariff regime with the United States in autos, because we know that will deliver the strongest North American auto industry. But if the U.S., through the CUSMA review, insists on some form of auto tariffs, we'll ensure that companies that sell vehicles in Canada are strongly incentivized to produce in Canada. And to support this objective, we will explore strengthening our automotive remissions framework through a tradable credit system that would reward companies that produce and invest in Canada. In short, companies that manufacture and invest here would earn credits, while companies seeking to sell vehicles in Canada without paying tariffs would be required to purchase those credits.
To fully take advantage of the opportunity of these measures, Canada needs to benefit from these partnerships and access new global markets. Canada has already signed free trade agreements with 51 countries, representing 1.5 billion consumers. Our government is working along that path and has already signed 12 new trade and security partnerships in 4 continents in just 6 months.
Our recent agreement with China will allow a limited number of EVs from China to enter the Canadian market, fewer than 50,000 a year in a market of 1.8 million cars. This will help provide Canadians with more affordable, energy-efficient options. At the same time, we expect this agreement to catalyze considerable joint venture investment in Canada with trusted Canadian partners to create new auto manufacturing jobs and strengthen the build-out of our EV supply chain. Finally, as we transform our auto sector into a global leader in electric vehicles, we're working to protect workers and businesses today so they can bridge to the economy of tomorrow. We're providing additional income support to workers and to employers through a new work-sharing grant, giving them the flexibility that employers need to retain workers and prevent layoffs. This has already helped prevent more than 3,700 layoffs in the auto sector alone. We're also establishing a new workforce alliance, bringing together industry, labor, training partners to address skill gaps, remove bottlenecks, and catalyze private investment. We're launching the Automotive Task Force to drive coordinated action between our government and the province of Ontario to build the cars of the future. We're breaking down barriers and working together across government, industry, and labor with shared focus on delivery. Ensemble, ces nouvelles mesures forment une nouvelle stratégie.
These measures will form a new strategy that will allow our auto industry to make Canada a leader in the world in the manufacturing of electric vehicles. We will focus on what we can control and help the Canadian auto sector, as well as the workers and communities that depend on it. We will help them to adapt, to be competitive, and to succeed.
When Henry Seth Taylor built Canada's first car, he could not have imagined what this industry would become. The Canadian automakers would assemble the world's first affordable car, the Ford Model T. That Canadian automakers would scale up production rapidly to become the second largest producer of cars in the world by the end of the First World War. That in World War II, the industry would quickly shift almost entirely to military production, producing more than 800,000 military transport vehicles and 50,000 tanks to help win that war. These feats were the result of Canadian determination and ingenuity. They were the product of an industry that adapted, pivoted, and when necessary, transformed. That's what we must now do to build the vehicles of the future. Lower emission, autonomous, more reliable, more affordable vehicles. For a stronger, more resilient, more independent Canadian economy that creates great jobs here at home. That is what we are building together. That is a confident Canada. That is Canada Strong. Thank you very much. Merci beaucoup.
Thank you, Prime Minister.
Prime Minister announcing a change, wide-ranging changes in Canadian auto policy. For one thing, they are working now on tariffs or credits and tariffs aimed at encouraging companies to go on manufacturing cars in this country. Now, you will get these credits to help offset imports on cars that you're bringing in from America. And you can also sell these tariffs to other companies bringing in cars into this country. I mean, the background here is that U.S. auto production in Canada has collapsed. Toyota and Honda, between them, last year made 3/4 of the cars assembled in this country. The rump was made by GM and Stellantis. So they're keeping counter tariffs that they put on U.S.-made cars and trucks in retaliation for U.S. levies, but they are launching consultations on this new import credit scheme that favors companies that still make their vehicles in Canada. But of course, the background is Canada doesn't have any automakers. They're all foreign companies, despite what the Prime Minister liked to say. It's a bunch of reforms here. They are, as the auto industry has been pleading for, getting rid of a minimum level of zero-emission vehicles, and they say they're bringing in new standards for fuel efficiency that will replace that electric vehicle mandate that, as Bloomberg points out, was hated by the industry. Those rules that are being scrapped required car makers to ensure that at least 1/5 of their sales were zero-emission vehicles in the near term. So now they're bringing in these new greenhouse gas emission standards with a goal of eventually having 90% of new sales be electric by 2040. And interestingly, they are bringing back the incentives. If you're a consumer who buys or leases an EV, the government is going to spend about $2.3 billion providing incentives of as much as $5,000 for battery electric EVs and $2,500 for plug-in hybrids. But it applies only to autos made in countries with which Canada has a free trade deal. So you won't be getting any of those incentives if you buy this. If you're lucky enough to get one of these tiny numbers of Chinese cars that they're bringing in. And this is interesting as well. They're talking about restrictions that may include in using Canadian software on these Chinese cars, because there have been concerns that these will ultimately remain under control of interests in China if the Chinese supply all the software. Ontario Premier Doug Ford has called them spy cars. He's not alone in those concerns. Okay, we'll have lots more on that on BNN Bloomberg throughout the day. Just want to give you a bit of breaking news as well. That potential merger between Rio Tinto and Glencore has fallen apart. We knew that the deal, we heard that the deal was in trouble. And so that's another story we'll be following throughout the day. Okay, Alphabet reported its Q4, and investors are nervous about massive planned AI spending. Investors, it seems, wary about massive spending by Alphabet, parent of Google, on artificial intelligence growth. Company almost doubling its capex plans for 2026. Let's get more from Dan Ives, Global Head of Tech Research at Wedbush. Dan, always great to get your insight, and thanks for joining us. What do you think? Was this a shock, Alphabet's big capex?
You want to see them double down on capex. It speaks to the AI revolution. I mean, if you look, the monetization that they're showing is I think is something that has surprised investors on the upside. Look at Google Cloud, 48% growth. Mm-hmm. So the point is, I get some of the worries, but they're showing it, they're proving it, and I think that's been a huge part of their success.
Yeah, Google Cloud year-over-year revenue growth of about 48%. I mean, it's a giant business, but it's growing at an incredible pace.
Look, a year ago, the Toronto cab driver was bearish on Google. And now look where we are. I mean, the point is it's been a massive success story. They're playing offensive in terms of doubling down on capex. Advertising's been so strong. Look, I think we're seeing just this white knuckle period across tech. Google down today on this print, on the capex. It is a massive head scratcher. It creates the opportunities.
What are they actually spending on? It's actual physical data centers?
Look, there's more data centers under construction today than active data centers. And you think about all their customers, both on the consumer side as well as on the enterprise side. I mean, data centers is it's the hearts and lungs of the AI revolution. So Google needs to spend. Look, it's no different than look at Oracle, 45, 50 billion that they're going to need to spend to get Oracle deal. Look what Microsoft's doing. I mean, we're talking trillions being spent, and Google is not just going to watch us from the sidelines. They're going to be front and center.
God, these numbers are mind-blowing, though. CapEx in 2026 expected to be about 180 billion. Now, the street had been looking for about 120 billion. So I said almost double. That was a bit of an exaggeration. But it's going to be, excuse me, about 50% higher than the street had expected.
Look, but you want to see them do this because the fact that they're doubling down, that speaks to their confidence about monetization of fourth industrial revolution. You know, if they slow down, let's just say they slow down CapEx and cash flow and EPS came up this year.
Right.
I wouldn't view that as a good thing, even though maybe in the near term it helps numbers. It's talking about what this is going to look like over the next 2, 3, 4 years. Look, it speaks to everything we're seeing across tech. This is a fourth industrial revolution. We're in year 3 of a 10-year build-out.
Year 3. It's just amazing. There must be a rush to get electrical contractors and equipment? It must be inflating prices for one thing.
Oh, yeah. I mean, I'll tell you, a good thing to be right now is someone that works in a data center. You know, they might have a few Rolexes that they're wearing.
Yeah.
Because the reality is that it's a supply demand that we're seeing in terms of data center build out. Now, the second, third, fourth derivatives are playing out across power, infrastructure, because this is now, it's a race. And that's what you're seeing in big tech play out.
And Gemini is their flagship AI product, and RBC reckons that it continues to catch up on ChatGPT.
Narrowing the gap. And I think right now, I mean, if you look at Altman and OpenAI, they're looking behind their back and they see Gemini coming about 100 miles an hour in that left lane in a Ferrari. And I think that's something that's been a huge part of the success of Google. Go back to a few years ago. I mean, it was really viewed like they dropped the ball. And you got to give credit to Sundar and Google and everything that they've done. I think the success is there. And that's why, especially after DOJ lost on the Google in terms of the breakup, I mean, they're not just going to sort of sit here on the treadmill. They're going to aggressively go after this market.
And it looks like their cloud revenue alone is now at top $70 billion US on an annual basis.
Yeah, and think about it, I mean, that was just Microsoft's game. Now, I mean, obviously Google benefiting, we'll see it from Amazon tonight. But look, this isn't just it's not just Microsoft, it's not just Google, it's not just Amazon, it's not just Oracle. We're talking about something we haven't seen, in our lifetime. And you're talking about fourth industrial revolution that's just happened to be playing out, and it's big tech that's winning. Now, look, is there a digestion period with that? Yes. But I think this is something that's more and more bullish for Google in terms of these numbers.
Apparently, more than 80% of software as a service companies are using Gemini. Give us your thoughts on this sell-off in some of the traditional software stocks we've seen, or data management, data providers, Adobe, Thomson Reuters. Are investors overreacting here?
Look, I think I'd view it as a software Armageddon that's playing out. I mean, this is something from a structural perspective. They're essentially throwing out the sector. Look, I mean, I've covered tech for, decades, right? And I've never seen anything like this.
Wow.
In my view, Salesforce, Microsoft, you look at some of these names like CrowdStrike and cybersecurity, I think this thing has gotten way overdone. And look, is it a headwind? Yeah. But this is not something that should cause a structural breakdown and essentially throw in the sector in the garbage. And I think those are the opportunities.
Right. So investors are being too hard on some of these names, you think, right now?
I think I get it, it's a headwind, but way overreaching, as well as also the use cases are going to ultimately be created within software. And I think that's why you look at the install base, the hundreds of thousands of customers they have. This is not all just going to get done by Microsoft, Google, and others. It's software that's going to play a huge role.
We better go, Dan. Always great hearing from you. Thank you very much indeed.
Thanks.
Dan Ives of Wedbush. Coming up, Hot Picks. We're focusing once again on one of our favorites, the biotech sector. We'll be right back. Time for Hot Picks. Our guest covers the biotech sector. Her top idea is Viridian Therapeutics. We are joined by Laura Chico, Managing Director in Equity Research at Wedbush. Thank you very much for joining us, Laura.
Thank you, Andrew.
Start off with Viridian, please. What are they working on?
Sure. Well, and just maybe taking a step back first, all of our top picks here have three themes that really tie them together: rare disease focus, differentiated product, and potential catalysts. And that's exactly where Viridian fits. So their focus is thyroid eye disease, or TED. This is a rare disease, autoimmune condition, bulging, painful eyes. Your treatment options today are surgery or 6 months of IV infusions with an approved drug, Tepezza. And Viridian is really hoping to change this treatment dynamic. They have a drug under review right now, Veligrotug. We're hoping to get an approval decision by June. And this would reduce both the number of infusions you need and the duration of each of those infusions. But I think the real interesting part for Viridian here is what's next. And that is this quarter, we're getting data from a trial called Reveal 1 for their next-gen product, Elegrobart. And this would be a once-a-month at-home injection, kind of like an Ozempic pen. So if we see Tepezza-like efficacy in this first quarter data, I think that's a real game changer in terms of how we treat TED, but also a re-rating would be due for the stock here.
You said this is a rare disease, though, so the market is curtailed in that sense?
Yeah, so we're talking about fewer than 200,000 patients in the U.S.
Right. So what should investors bear in mind then? I mean, does the margin on a drug like that tend to be bigger?
Yeah, and I think Tepezza, even though it hasn't had a significant penetration in the TED market, right now Amgen is marketing this product and it's at about a $2 billion run rate. So despite the number of patients, there's still a substantial unmet need in the market for this. So if we've got Veligrotug launching kind of the middle of next year, and then hopefully Elegrobart maybe a year after that, I think there's still a multi-billion-dollar market opportunity just in the U.S. market here.
So the Edgewise Therapeutics is your next idea. They carried out a trial, and there was some statistical noise, but 2 patients should, in fact, have been excluded. Can you just walk us through what happened there, please?
Yeah, so Edgewise Therapeutics, this is for their cardiac focus in HCM. This is another genetic cardiac condition. Mm-hmm. And the idea with 7500, the Edgewise drug, is hopefully that we can dose something that has a little bit safer profile and is easier to administer. Right now, the standard of care would be Camzyos from Bristol Myers Squibb, a cardiac myosin inhibitor. Well, it's changed a lot in how we treat HCM. It's not without liabilities and some trouble in administration. You have to use echocardiograms to titrate patients up. Hopefully 7500 will present a different profile. We'll be getting some phase 2 data from Edgewise, but you mentioned earlier, the data last year, I think, gave investors pause. At the end of last year, we also got a new safety update from Edgewise. I think a lot of those atrial fibrillation concerns have been alleviated, and the next update in the second quarter will help us understand the efficacy and safety profile a little bit better.
And your final idea here is a company called BioCryst. What are they aiming to fix, or what ailment are they going after?
Sure. So they are focused on something known as hereditary angioedema, or HAE. And this is probably even a smaller market. We're talking about 10,000 patients for HAE. And this is a rare genetic disease that you have random swelling attacks. These can occur in your hands, your feet. The biggest problem is when they occur in your throat, and these become life-threatening. So patients tend to take a therapy that is prophylactically administered, so with regular frequency, to prevent these attacks. And that's what Orladeyo's BioCryst product Orladeo does right now. This is a $600 million plus drug a year today. And I think investors are really concerned, what is the tail for Orladeyo? How long do we stick around? There have been recent entrants into the HAE space in the prophylactic realm, and I think there's concerns there. We disagree. We see a path forward for additional growth, and BioCryst recently acquired another company, Astria Therapeutics. They have a phase 3 program. And this is a long-acting injectable prophylactic treatment that patients would take 2 times or 4 times a year instead of having to take twice-a-month injections, which is the standard right now if you don't take Orladeyo.
Right. And sorry, Orladeyo, though, right now is an oral treatment that you take once daily?
Correct. Yes. So if you don't want to do the injections, I think BioCryst has a really unique offering with the oral product with Orladeyo. They've been showing nice steady growth here, and they're guiding to over $625 million in revenue this year. The stock is trading at about 2 times 26 revenue, consensus revenue, but the mid-cap peer group trades at about 5 times. So I think beyond Orladeyo, we do have some pipeline updates coming early 27 for the Navenibart program, but then another orphan disease readout is expected towards the end of this year. This is an ultra-orphan skin condition. I think neither of those are really reflected in the stock valuation. So if we can have some commercial execution paired with more pipeline updates, I really like the setup here for BioCryst.
Laura, thank you very much indeed. Laura Chico is Managing Director in Equity Research at Wedbush Securities. That was great. We got 3 companies I've never heard of. News to me, anyway. Thank you very much indeed.
Thank you, Andrew.
Coming up, one last check on the markets, and we'll tell you more about how touchscreen kiosks in restaurants are getting people to order more. Let's have a look at the North American markets before we go. And you can see there is pressure on stocks right now. Worrying signs of weakness in the U.S. job market, increasing job layoffs, for example, disturbing investors, and U.S. markets slipping. The S&P down about 1.5%. Same for the NASDAQ, and Toronto down as well in tandem. Just looking here at the big traders, big heavy dollar value traders. Celestica, as I mentioned earlier, rallying. It is well off its record highs, jumping about 6%. Maybe Google's massive plans for capital spending, $180 billion US capex this year. It'll stimulate demand for hardware, and that's where Celestica steps in. Constellation Software actually rallying a little bit, almost 2%, but that's been an ugly stock to own over the past while. Thank you, Control Room. And Shopify down about 4%, BCE down about 3%. Looks as though the forecast not thrilling investors, and there was weaker than expected revenue, according to Bloomberg. Let's get to a story that caught our eye yesterday. The BBC has it, and apparently studies show that consumers spend more in a fast food restaurant anyway when ordering from a touchscreen. The BBC went to an industrial estate on the outskirts of Merseyside, near Liverpool. It's a company called Evoke Creative, and it makes these self-service terminals. And of course, they're popping up everywhere, McDonald's, your local library, and apparently they can significantly increase sales. So it's not just about getting rid of staff or speeding up service, it's also getting you to buy those extra fries. The founder of the company telling the BBC, "You're removing the psychology of speaking to someone and feeling judged, when we think that's a key factor. Would you like extra fries? Would you like to go large?" Now, this doesn't apply to all people, but he reckons there's a good proportion of people who may feel judged in those cases. And also, there's really good product imagery on the terminal, so you can get a better idea of what you are buying. And you are also asked, of course, at every stage on the journey, would you like to add this? Would you like to do that? And of course, that's likely to stimulate spending. Some research indicates that 61% of customers spend more at one of these terminals than a till. That's according to a London-based company called Vita Mojo, which provides this technology. And the increased amount of people spend said to be as much as 40%. So something to bear in mind when you're ordering burgers on one of those screens. Thanks very much for watching The Open.